What's the main strength of Lyft's IPO and the main weakness?
Well, the good news you would say about Lyft is everyone has heard of it. So if you're going to try to sell stock to retail investors like these guys obviously are, they have very good name recognition already. The trouble is, obviously, the financials are just not very good. To lose $1 billion on $2 billion of revenue isn't such a great thing if you really want to buy it for its fundamentals, as opposed to the supply and demand dynamics that we were just hearing about. It will be a very hot deal, but unfortunately, we don't think it'll perform very well.
I think this is really important, what you're just saying. Let's just emphasize this for anybody who's listening at home, because I'm bothered by the idea that retail investors are going to be the ones potentially left holding the bags. Can we go back to that full screen that was just up? I just want to reemphasize the point. The disclosures have been so bad that investors have no way to do the correct math.
That's true.
How different is that from a traditional, regular IPO?
Well, it's very similar to Snap, which is why the...
But I mean, how, just if you were looking at the average IPO...
Yeah, typically they give you the numbers that you would need to project the future in a way that you could get comfortable that a company that, for example, is losing $1 billion might not do that next year or the year after. These guys have not done that, right? They have a lot of momentum behind them. The market's been closed. There have been no IPOs of any consequence since Tencent Music in Techland. So the supply and demand dynamics set up very well for them, but if you rush to get the shares, you could end up, as you say, holding the bag.
Price to sales is quite attractive.
No, not attractive. $23 billion of valuation is, a very full valuation for this company. So to answer the question that you asked, do you want to own the stock? The question isn't do you want to own it. The question is do you want to own it at this price?
And do you want to take a flyer on it when you can't do the math?
And if you think that you can own it at a lower price later, then maybe you should wait. We have a scoring system that we use to evaluate tech IPOs, and the average tech IPO score of the last 5 or 6 years has been about a 6.3. Right? And so Snap was a 5.91, which is really low. That was very controversial. People love that name, and it was sort of like yeah, but the scores don't lie. Lyft is coming in at a 5.47. So we think there are good reasons to be cautious about this one.
You also see the Lyft and Uber comparison similar to a Snap and Facebook comparison?
Very similar. Except, Lyft is even more similar to Uber than Snap was to Facebook in a way. But what they both do is they have the same customers. So Snap has to go get advertising budgets from big advertisers, and they have to get that budget away from Facebook. Similarly, Lyft and Uber compete for the same money from the same people. And similarly, Uber is much bigger than Lyft is.
In terms of your scoring ratio that you just mentioned, have you had some in the past that you've got wrong? That you've had a low score and they've done well?
Sometimes they're wrong for a little while, but they don't stay wrong. Lyft traded very well, or Snap rather traded very well in the beginning, right? It looked like it might break the score, but ultimately it mean reverted.
And what are you looking at for some of the ones that Dom mentioned that are coming? Pinterest, WeWork, some of the big names.
Pinterest will score. I mean, Pinterest, interestingly, is actually very similar to Snap in a lot of ways. It just, as far as what the business does, it just doesn't lose as much money. So think of, Pinterest as premium Snap, if that makes sense.
So you're likely to warm to that one, or
it
you're still saying
it will score much better. It will score much better than Snap did.
And on WeWork, I mean, we got a glimpse at some of their financials just yesterday or the day.
Yeah, that's going to be very, very tough. To lose $2 billion on $2 billion of revenue when you actually take risk on the real estate is going to be a very tough score, given our scoring system.
Seems like there's a bit of a theme here. I mean, are we just now later in the sort of tech IPO kind of time frame such that the scores are all lower than they were a couple of years ago?
So that's very interesting. So the scores that we've seen over the last year are coming in at about 6.03, 6.04 on average, versus an all-time average of 6.3 and change. So yes, we've seen lower quality companies over the last year.